Part 1. Control your emotions before you control your money, because investing decisions made from fear, greed, excitement, or panic can destroy a good strategy. Before buying or selling, stop and ask yourself whether your decision is based on facts about the investment or simply on what the market is doing today. If the reason is mostly emotional, wait until you can think clearly. The market will continue creating opportunities, but emotional decisions can permanently damage your capital. Do not check your portfolio constantly, because frequent checking can make normal price movements feel like emergencies. A strong business can fall 10%, 20%, or even more without its long-term value changing by the same amount. If you constantly watch every price movement, you may start reacting to noise instead of fundamentals. Check your investments according to a planned schedule and investigate meaningful changes in the business rather than every small movement in the stock price. Learn to become comfortable with temporary losses, because volatility is part of investing. If you cannot emotionally tolerate seeing your portfolio fall, you may sell precisely when long-term investors should be evaluating opportunities. Before investing, mentally prepare yourself for significant declines. Ask yourself how you would behave if the market fell 30% tomorrow. If you know you would panic and sell everything, your portfolio or investment strategy may be too aggressive for your psychology. Never confuse a falling stock price with a failing business, because price and value are different things. When a stock declines, investigate whether the company's revenue, earnings, cash flow, competitive advantage, management, and long-term prospects have actually deteriorated. If the business remains strong while the price becomes more attractive, the decline may create an opportunity. If the business itself has deteriorated, the falling price may be justified. Train your mind to investigate before reacting. Never confuse a rising stock price with a successful investment, because a stock can rise far beyond reasonable expectations. When everyone around you is making money, your brain naturally wants to participate. Instead of asking how much the stock has already risen, ask whether the underlying business has improved enough to justify the current valuation. If enthusiasm has pushed the price far beyond realistic future earnings, continuing to buy simply because prices are rising can become dangerous. Develop emotional independence from other investors, because the crowd can be extremely confident and extremely wrong. When everyone is buying, you do not have to buy. When everyone is selling, you do not have to sell. Study the underlying business and valuation and make decisions based on your own analysis. The goal is not to predict what the crowd will do tomorrow. The goal is to understand what you are buying and whether the current price provides an attractive long-term opportunity. Stop trying to predict every market movement, because nobody consistently knows what the market will do next week or next month. Instead of spending your energy predicting short-term prices, focus on things you can actually analyze, such as business quality, valuation, financial strength, competitive advantage, and management. This shift in thinking reduces anxiety and helps you concentrate on long-term factors that have a greater connection to investment returns. Build patience deliberately, because good investments may require years to produce their full potential. Your mind naturally wants immediate results, especially after seeing other people make money quickly. Resist that temptation. When you purchase a strong business at a reasonable valuation, give the business time to grow earnings and cash flow. Do not abandon a good investment simply because it did not move upward immediately. Time can become one of your greatest advantages when your behavior remains disciplined. Stop comparing your portfolio with other people's portfolios, because comparison creates unnecessary emotional pressure. Someone may make 100% in a year through a risky investment, while you make 12% through a disciplined strategy. That does not automatically mean their strategy is better. You rarely know the full amount of risk they accepted or the losses they experienced elsewhere. Measure your progress against your own financial objectives, risk tolerance, and long-term plan rather than someone else's temporary results. Do not chase an investment because someone else became rich from it, because you are seeing the result without experiencing the original uncertainty. A successful investor may have purchased a company when the future looked unclear and held it through years of volatility. By the time you discover the story, the valuation may already reflect much of the optimism. Study the current opportunity independently. The question is not whether someone else made money from the stock. The question is whether the investment makes sense at today's price. Part 2. Learn to say "I do not know" because intellectual humility protects investors from unnecessary mistakes. You do not need an opinion about every company, industry, technology, or market event. If you cannot understand a business, its financial statements, or its risks, simply leave it alone. Missing an opportunity is usually less damaging than investing in something you do not understand. Strong investors understand that refusing to play certain games is itself a powerful investment decision. Avoid the need to always be invested because sometimes the best decision is to wait. If you cannot find an attractive opportunity that fits your standards, there is nothing wrong with holding cash or waiting for better conditions according to your strategy. The pressure to constantly buy can cause investors to lower their standards. Patience gives you the ability to say no until an opportunity becomes sufficiently attractive. Create written investment rules before emotions become intense, because your future self may behave differently under pressure. Write down why you are buying an investment, what you believe the business is worth, what risks could invalidate your thesis, what would make you reconsider, and how large the position should be. When volatility arrives, read your original reasoning. This can help you distinguish temporary emotional discomfort from genuine changes in the investment. Write down your reasons for buying before purchasing because writing exposes weak thinking. If you cannot clearly explain why you are investing, you may be buying because of excitement, social media, a friend's recommendation, or recent price performance. Write a simple explanation of the business, its competitive advantage, expected growth, valuation, major risks, and reasons the market may be mispricing it. If the thesis becomes confusing when written down, that confusion is useful information. Define what would make you sell before you buy, because otherwise emotions can control your exit decision. A sell decision might result from a permanent deterioration in the business, an extreme valuation, a major change in your original thesis, unacceptable risk, or a better opportunity, depending on your strategy. Do not create an automatic rule that every falling stock must be sold. Instead, identify the fundamental conditions that would genuinely change your assessment. Do not move your standards just because you are excited about a stock. Investors often create strict rules when they have no position and then abandon those rules when they discover an exciting opportunity. They suddenly accept higher valuation, more debt, weaker management, or greater uncertainty because they want to participate. Keep your standards consistent. If the company fails your requirements, enthusiasm should not change the requirements. Treat cash as a strategic resource rather than as wasted money. Cash can provide stability, flexibility, and the ability to act when attractive opportunities appear, although holding excessive cash can also reduce long-term returns. The psychological benefit is important because an investor with adequate liquidity may feel less pressure to sell investments during temporary market declines. Maintain an appropriate cash position based on your personal circumstances and investment strategy, rather than according to fear or excitement. Do not let fear force you into permanent decisions based on temporary events. Markets can fall because of recessions, geopolitical events, disappointing earnings, interest rate changes, or investor panic. Some events genuinely damage businesses, while others primarily affect sentiment. When fear becomes intense, slow down and separate temporary uncertainty from permanent deterioration. Ask what has actually changed in the underlying business rather than assuming that a frightening headline automatically means you should sell. Do not let greed make you abandon risk management. When investments rise quickly, investors often become overconfident and start believing that they have special skill. They may increase position sizes, use leverage, or chase even more speculative opportunities. Remember that rising prices can make you feel smarter than you actually are. Review your portfolio objectively when confidence becomes extremely high. Protecting your capital matters even when everything appears to be working. Recognize that overconfidence is one of the most dangerous psychological biases in investing. A few successful trades can convince someone that they understand the market better than they actually do. Success can come from skill, favorable conditions, luck, or a combination of all three. Keep analyzing your mistakes and maintaining appropriate risk controls even after a strong period of performance. Your goal is not to prove that you are smarter than everyone else. Your goal is to compound capital responsibly. Part 3. Never confuse luck with skill. If an investment doubles quickly, Examine whether your analysis predicted the outcome or whether an unexpected event simply helped you. Similarly, if a well-researched investment declines, do not automatically conclude that your entire process was wrong. Judge your decision by the quality of your reasoning using the information available when you made it. Good decisions can produce bad short-term outcomes, and poor decisions can occasionally produce excellent short-term outcomes. Keep an investment journal because memory becomes biased after the result is known. Write down your expectations, assumptions, risks, valuation, and reasons for buying before the outcome occurs. Later, compare what you predicted with what actually happened. Over time, you will discover whether you repeatedly overestimate growth, underestimate competition, ignore debt, or react emotionally to volatility. This turns investing into a learning process instead of a series of disconnected experiences. Study your mistakes without attacking yourself because the purpose of reviewing mistakes is to improve your process. Identify exactly what went wrong. Perhaps you misunderstood the business, paid too much, ignored debt, followed a popular story, underestimated risk, or sold because of fear. Then create a rule designed to prevent the same mistake in the future. A mistake becomes valuable when it permanently improves your decision-making. Avoid revenge investing after a loss because the desire to recover money quickly can produce reckless behavior. After losing money, investors sometimes increase position sizes, use leverage, or chase speculative stocks because they want to get back to their previous balance immediately. The market does not owe you a recovery. Accept the loss, review what happened, and return to disciplined decision-making. Your next investment should be based on its own merits rather than your emotional desire to erase the previous loss. Do not let your purchase price control your emotions. Investors often become psychologically attached to the price they paid and want the stock to return to that exact number. But the market does not care about your entry price. Evaluate the investment from today's perspective. If you own no shares today, would you still want to buy the company at its current price? If the answer is no because the business has deteriorated or the valuation is excessive, your original purchase price should not prevent you from reconsidering. Learn to tolerate boredom because excellent investing can be surprisingly uneventful. Constant buying and selling creates excitement, but excitement is not the same thing as wealth creation. A strong long-term investor may spend more time reading, thinking, waiting, and doing nothing than trading. If your strategy feels boring, that can be a positive sign. You are not required to create activity simply to feel productive. Stop treating investing like entertainment because financial decisions become dangerous when excitement becomes the main objective. Social media, financial television, breaking news, and constant market commentary can make investing feel like a sport. Your money, however, is real. Focus on business fundamentals and long-term outcomes rather than finding the next exciting story. If you want entertainment, keep it separate from the money you depend on for your financial future. Reduce exposure to financial noise because too much information can make decision-making worse instead of better. You do not need to know every market headline or every analyst prediction. Excessive information can encourage impulsive reactions and confirmation bias. Choose a limited number of high-quality sources, prioritize company filings and reliable financial information, and give yourself periods without market commentary. Better information combined with less noise can improve the quality of your thinking. Do not allow social media to become your investment advisor. Online platforms can provide useful ideas, but they also reward sensational claims, extreme predictions, and emotional content. Someone claiming that a stock will become the next giant company may have completely different financial circumstances, incentives, and risk tolerance from you. Use social media as a source for research ideas rather than as proof. Verify important claims through reliable primary information before risking your money. Beware of confirmation bias because your mind naturally searches for information supporting what you already believe. If you become excited about a company, you may unconsciously ignore negative information and search for positive opinions. Deliberately look for reasons your investment could fail. Read the bear case, examine competitors, investigate weaknesses, and ask what a skeptical investor would say. If your thesis survives serious criticism, your confidence can become more rational rather than emotional. Part 4. Actively search for information that disagrees with you because disagreement can expose weaknesses that enthusiasm hides. Before making a large investment, Ask someone or yourself to build the strongest possible case against the investment. Identify the most serious competitive threat, valuation risk, financial risk, and operational risk. If you cannot answer those objections, you may not understand the investment well enough. The goal is not to prove yourself right. The goal is to discover the truth before committing capital. Do not fall in love with a company because emotional attachment can prevent rational decisions. Investors sometimes become fans of a brand and automatically assume its stock will succeed. A great product does not necessarily mean a great investment. The business may be wonderful while the stock is overpriced. Separate your admiration for a product from your evaluation of the company's economics and valuation. You are buying an economic interest in a business, not becoming a fan club member. Learn to change your mind when the facts change because consistency is not always a virtue in investing. If new evidence shows that your original assumptions were wrong, refusing to update your opinion can turn a small mistake into a major loss. Changing your mind because of strong evidence is not weakness. It is rational behavior. The key is to distinguish between meaningful fundamental information and temporary market noise. Update your thesis when the business changes, not simply because the stock price moves. Do not change your thesis merely because the stock price changes. If your original analysis was based on a company's long-term earnings power and competitive advantage, a daily price movement does not automatically invalidate that analysis. Reassess the business and valuation first. A lower price may improve the opportunity, while a higher price may reduce it. The stock price is information, but it is not the entire investment thesis. Use a checklist before major purchases because checklists protect you from emotional shortcuts. Review the business model, financial health, growth prospects, competitive advantage, management, valuation, risks, position size, and reasons for selling. A checklist does not guarantee success, but it forces you to slow down when excitement is pushing you toward an impulsive decision. The more important the investment, the more valuable deliberate process becomes. Create a cooling-off period before large investments because excitement is temporary while your financial commitment can last for years. If you discover an investment and immediately feel that you must buy before the price rises, pause. Spend additional time researching the company and identifying risks. If the opportunity remains attractive after the excitement disappears, your decision is more likely to be based on analysis. Genuine opportunities generally do not require you to abandon your thinking process. Never let FOMO decide your investment timing. Fear of missing out becomes powerful when prices are rising and everyone appears to be making money. You may feel that buying immediately is the only way to participate. Instead, remember that you are not required to own every successful stock. If the valuation is unreasonable, walking away is a valid decision. Missing a gain is usually less damaging than entering an investment you do not understand at an unjustifiable price. Accept that you will miss opportunities because no investor can own every great business at the perfect price. Trying to capture every opportunity encourages overtrading and weakens concentration on your best ideas. There will always be another company, another innovation, another market cycle, and another investment opportunity. Focus on the opportunities that fit your knowledge and financial objectives. Peace of mind comes from accepting that missing some gains is part of disciplined investing. Do not measure your intelligence by your short-term investment returns. A person can make a huge gain from a risky decision without having a superior investment process. Another investor can make a modest return while following an excellent process during a difficult market. Evaluate whether your decisions are becoming more rational, whether your mistakes are decreasing, and whether your portfolio is aligned with your goals. Wealth creation is a long game, so short-term results should not define your identity as an investor. Separate your ego from your investments because admitting that you are wrong is easier when your identity is not attached to being correct. If you believe that selling a stock means admitting failure, you may hold it long after the investment thesis has collapsed. Treat each investment as a hypothesis that can be updated. Your objective is to allocate capital intelligently, not to win an argument with the market. Part 5. Never try to prove yourself right to the market because the market does not know or care about your opinion. If a stock falls after you buy it, arguing with the price will not change the business. Instead, Investigate what the market may be seeing and determine whether the underlying facts support or contradict your thesis. You do not need the market to admit that you were right. You need your capital to be allocated intelligently. Understand that patience and inactivity are different from laziness. Patience means deliberately waiting while continuing to monitor your investments and opportunities. Laziness means failing to review important information. A disciplined investor can spend months doing nothing with a stock position while still actively studying the business. The key is intentionality. Do not trade simply to feel productive, but do not ignore meaningful changes either. Avoid compulsive trading because every unnecessary transaction creates opportunities for mistakes, costs, taxes, and emotional reactions depending on your jurisdiction and account. Before every trade, ask what specific information justifies the action. If the answer is simply boredom, fear, excitement, or the desire to do something, don't trade. Long-term investing rewards decisions that are based on meaningful changes rather than constant activity. Focus on process rather than prediction because you cannot control the market's short-term outcome. You can control how much you research, how much risk you accept, how you value businesses, how you diversify, and how you respond to volatility. A strong process will not eliminate losing investments, but it can improve the quality of your decisions over many years. Stop demanding certainty from an uncertain system and instead demand discipline from yourself. Develop a long-time horizon because short horizons magnify emotional reactions. If you need your investment money soon, a major market decline can create serious pressure. If your money can remain invested for many years, you have more time to allow businesses and markets to recover and compound. Your time horizon should influence how much volatility you can realistically tolerate. Think in years rather than days when your investment thesis depends on long-term business growth. Think like a business owner rather than a stock ticker watcher. When you purchase shares, remind yourself that you own a portion of a real business. Ask how many customers it has, what products it sells, how it makes money, how strong its competitors are, and how much cash it can generate. This mindset reduces the temptation to treat every price movement as a signal to trade. You become more interested in business performance than market excitement. Imagine that the stock market closed for several years because this thought experiment reveals whether you actually believe in the business. If you could not sell tomorrow, would you still be comfortable owning the company? Would you trust its management, balance sheet, competitive position, and ability to generate cash? If the answer is no, you may be relying too heavily on short-term price movements. The exercise encourages you to think about ownership rather than speculation. Do not buy something simply because it is going up. Momentum can continue for a while, but rising prices alone do not tell you whether the underlying asset is attractively valued. Ask what fundamental improvement supports the price increase and whether that improvement is already reflected in expectations. A rising price can increase your emotional confidence while simultaneously reducing your potential future return if valuation becomes excessive. Do not sell simply because something is going down. A declining price is a reason to investigate, not an automatic command to exit. Determine whether the decline comes from temporary sentiment, broad market conditions, disappointing but recoverable results, or genuine deterioration in the business. Your decision should depend on the future economics of the investment rather than the emotional discomfort caused by seeing red numbers on your screen. Understand that volatility can create opportunity when your psychology is strong enough to remain rational. When other investors become fearful, attractive businesses can sometimes trade at more reasonable prices. But volatility alone does not guarantee an opportunity. You still need to analyze the business and valuation. The psychological advantage comes from being prepared before the crisis occurs so that fear does not force you into irrational decisions. Part 6. Prepare mentally for market crashes before they happen because it is easier to remain calm when you have already imagined the scenario. Decide in advance how you will respond to a major decline. Review your cash needs, portfolio diversification, investment thesis, and risk tolerance. When a crash arrives, you should not be designing your entire strategy in the middle of panic. Preparation creates psychological stability. Do not use emergency headlines as automatic trading signals. News can be important, but the first reaction of investors may be emotional and exaggerated. When major news arrives, Determine whether it changes the long-term economics of the business. Does it affect customers, revenue, costs, debt, competitive advantage, or future cash flow? If the answer is unclear, wait for better information instead of immediately making a permanent financial decision. Learn to distinguish uncertainty from risk because they are not identical. Uncertainty means you do not know exactly what will happen. Risk involves the possibility of permanent financial loss. A company can face short-term uncertainty while still having strong long-term economics. Another company can appear predictable while carrying enormous financial risk. Instead of demanding certainty, evaluate whether the potential permanent loss is acceptable relative to the possible reward. Avoid investments that require perfect predictions because the future is impossible to forecast precisely. If your investment only works if interest rates move in one exact direction, a competitor fails, customers behave exactly as expected, and economic growth remains strong, the margin for error may be too small. Prefer situations where reasonable variations in your assumptions still leave the investment potentially attractive. Robust investments are psychologically easier to hold because they do not require everything to go perfectly. Reduce decision fatigue by creating simple rules for your portfolio. Decide in advance how you research investments, how much you are willing to allocate, how often you review them, and what information would cause you to reconsider. Too many spontaneous decisions create more opportunities for emotional mistakes. A simple process allows your attention to focus on the few decisions that actually matter. Do not make investment decisions when you are emotionally overwhelmed. Extreme fear, anger, excitement, or frustration can narrow your thinking and make immediate action feel necessary. If possible, pause and give yourself time to evaluate the situation calmly. Review your investment thesis and relevant facts. Financial decisions deserve a state of mind where you can consider both upside and downside rather than focusing on whatever emotion is strongest at that moment. Be especially careful after a major winning streak because success can create a dangerous feeling of invincibility. After several profitable investments, investors often increase risk because they believe their skill has been proven. They may forget that market conditions can change and that luck can contribute to results. Treat success as a reason to review your process, not as permission to abandon risk controls. Staying disciplined after winning is just as important as staying disciplined after losing. Be careful after several losses because repeated disappointment can make you either excessively fearful or recklessly aggressive. Some investors stop investing entirely after a crash, while others take huge risks to recover quickly. Neither response is necessarily rational. Review your portfolio objectively and determine whether the losses came from market volatility, poor businesses, excessive valuation, or flawed decisions. Then make adjustments based on evidence rather than emotional exhaustion. Do not let a temporary market environment change your fundamental personality as an investor. During a bull market, you may feel naturally aggressive, while during a bear market you may suddenly believe that stocks are permanently dangerous. Your investment philosophy should not be rebuilt around whatever emotion the current market creates. Maintain consistent principles and adjust only when evidence shows that your strategy or circumstances genuinely require change. Part 7. Practice delayed gratification because wealth building often requires giving up immediate excitement for long-term benefits. Instead of constantly spending extra money or chasing fast returns, consider how capital could compound over many years. Every dollar invested responsibly represents potential future purchasing power, although returns are never guaranteed. The psychological skill is learning to value future financial freedom enough that you do not sacrifice it for every short-term desire. Remember that compounding requires both time and discipline. Even excellent returns cannot compound effectively if you repeatedly interrupt the process through panic selling, unnecessary trading, or excessive withdrawals. Think of your investment capital as a growing engine. Every unnecessary interruption reduces its ability to work over time. Focus not only on finding good investments, but also on creating a behavior pattern that allows your capital to remain productive for many years. Do not constantly search for the next multi-bagger because the obsession with extraordinary returns can push you toward unnecessary speculation. Sustainable wealth does not require every investment to become spectacular. A combination of saving, reasonable investment returns, controlled losses, and long-term compounding can be powerful. If your entire financial plan depends on finding one stock that multiplies hundreds of times, your psychology may become desperate and vulnerable to scams and hype. Be suspicious of anyone promising easy wealth because financial markets contain uncertainty and risk. Claims that an investment is guaranteed, effortless, secret, or capable of producing extraordinary returns with little risk should immediately make you investigate more carefully. Your desire to become wealthy quickly can make you ignore warning signs. Slow down when a promise sounds too good. Protecting yourself from fraudulent or reckless opportunities is part of successful investing. Never allow desperation to influence investment decisions because desperation encourages excessive risk. If you believe you must turn a small amount of money into a huge fortune quickly, you may start accepting leverage, speculation, concentrated positions, or unrealistic return expectations. Replace desperation with a realistic process. Increase savings where possible, invest consistently, improve your knowledge, manage risk, and give compounding time. Financial pressure should make you more disciplined, not more reckless. Understand your own risk tolerance by observing how you behave during declines rather than how confident you feel during rising markets. Many people claim they can tolerate large losses when markets are calm. Their real tolerance becomes visible when their portfolio falls sharply. Pay attention to your emotional reactions and use that information to build an appropriate portfolio. Your theoretical risk tolerance is less important than your actual behavior under stress. Do not choose an investment strategy that makes you psychologically miserable. A strategy may look excellent mathematically, but become useless if you cannot follow it during difficult periods. If extreme volatility causes you to panic, consider whether your asset allocation or position sizing is appropriate. The best strategy is not merely the one with the highest theoretical return. It is a strategy you can realistically maintain through different market conditions. Position sizing is psychological risk management because the size of a position affects how emotionally attached you become to its price movements. A small position may allow you to think clearly, while an oversized position can make every price movement feel personally important. Determine position sizes based on the risk of permanent loss, your conviction, diversification, and ability to tolerate volatility. Never increase a position simply because you are emotionally excited about the company. Never confuse conviction with certainty. You can have strong evidence supporting an investment while still acknowledging that you could be wrong. Certainty encourages excessive concentration and leverage, while rational conviction allows room for unexpected outcomes. State what you believe and what could prove you wrong. This keeps your confidence grounded in evidence rather than turning it into blind belief. Use probabilities instead of absolute predictions because investing rarely provides certainty. Instead of saying a company will definitely succeed, think about the range of possible outcomes and how likely each might be. Consider what happens if growth is stronger, normal, or weaker than expected. This probabilistic mindset reduces overconfidence and encourages better risk management. You don't need to know exactly what will happen. You need to make decisions where the potential outcomes are favorable enough relative to the risks. Avoid binary thinking because investments are rarely simply good or bad. A company can be excellent but overpriced, cheap but financially weak, risky but potentially attractive at a very low valuation, or strong today but vulnerable to future disruption. Think in degrees. Ask how strong the business is, how attractive the valuation is, how durable the advantage is, and how severe the downside could be. Nuanced thinking leads to better decisions than simple labels. Learn to wait for clarity when. Part 8. Learn to wait for clarity when uncertainty is unusually high. You do not need to immediately predict the outcome of every major event. Sometimes additional financial reports, management updates, industry data, or economic information can make the situation easier to understand. Waiting may mean missing part of a potential move, but it can also prevent you from making a poorly informed decision. Patience is especially valuable when the downside is difficult to estimate. Do not mistake activity for progress because buying and selling frequently can create the feeling that you are actively building wealth. Real progress comes from improving your financial position, owning productive assets appropriately, controlling risk, and allowing returns to compound. Ask yourself whether each action actually improves your expected long-term outcome. If it doesn't, doing nothing may be the more productive choice. Keep your lifestyle separate from your portfolio performance, because spending more simply because your investments performed well can weaken long-term compounding. A strong market year does not guarantee that future years will be equally strong. Avoid treating unrealized gains as permanent income. Build financial habits that remain sustainable during both strong and weak markets. Wealth is not only about how much your portfolio is worth. It is also about how intelligently you manage the resources it produces. Do not become emotionally dependent on constant profits. Some years will be excellent, some ordinary, and some negative. If you expect every year to produce positive returns, you may become frightened or frustrated when normal market cycles occur. Accept that investing involves uncertainty. Judge your strategy over a sufficiently long period rather than demanding immediate success every month or every year. Protect your attention because attention is an investment resource. If you spend hours every day watching prices, reading predictions, and reacting to headlines, you have less mental energy available for studying businesses deeply. Choose where your attention goes. Spend more time understanding a small number of meaningful factors and less time reacting to hundreds of irrelevant market movements. A calm mind can often make better decisions than an overloaded one. Avoid making financial decisions simply because you are bored. Boredom can create an urge to trade, especially when markets are quiet. You may start searching for opportunities that do not meet your normal standards simply because you want something to happen. Recognize boredom as an emotional state rather than an investment signal. If nothing attractive is available, doing nothing is a perfectly legitimate outcome. Do not let financial television or online commentary create artificial urgency. Many financial commentators are rewarded for attention, and dramatic predictions naturally attract more attention than calm uncertainty. You do not have to respond to every prediction. Ask whether the information changes your understanding of a business or merely creates emotional stimulation. Your portfolio should not require a reaction every time someone on television announces a new forecast. Be skeptical of precise predictions about the future because precision can create false confidence. Someone predicting that a stock will reach an exact price on an exact date may sound knowledgeable, but the future contains too many variables for such certainty. Focus instead on ranges, scenarios, probabilities, and underlying business economics. A realistic range of possible outcomes is more useful than an impressive-looking exact prediction that may be wrong. Do not make investment decisions to impress other people because social approval can push you toward unnecessary risk. An investment should serve your financial objectives, not your desire to appear intelligent or wealthy. You do not need to tell everyone about your winning stock. You also do not need to hide a sensible decision because it seems boring. Quietly following a disciplined strategy can be more valuable than receiving attention for a speculative success. Accept that boring investments can produce powerful results. A company does not need to be exciting, fashionable, or constantly discussed to generate long-term wealth. Businesses providing essential products and services can sometimes produce strong cash flows for many years. Train yourself to evaluate economic quality rather than entertainment value. If an investment feels boring but has understandable economics, strong finances, durable demand, and a reasonable valuation, do not dismiss it simply because it lacks excitement. Part 9. Avoid anchoring to past stock prices because investors often believe that a stock should return to a previous high simply because it traded there before. Past prices do not determine future value. Ask what the company is worth based on its current and future economics. A stock that was once $200 can be worth less today if the business deteriorated, while a stock that was once $20 can become far more valuable if the business has transformed. Focus on current fundamentals rather than historical emotional reference points. Avoid anchoring to round numbers because investors often create psychological targets such as waiting for a stock to reach $100 or believing a company is cheap because its share price is below $10. The number of dollars per share tells you very little about valuation without considering the number of shares and the company's financial performance. Evaluate market value, earnings, cash flow, growth, and business quality instead. A $5 stock can be extremely expensive, while a $500 stock can be reasonably valued. Resist the sunk cost fallacy because money already lost cannot be recovered by continuing to hold a poor investment. Once your capital is invested, the relevant question becomes what the money could earn from this point forward in each available option. If the business has deteriorated, your previous purchase price should not force you to continue owning it. Evaluate the future opportunity, not the emotional pain of admitting the past decision was wrong. Do not let taxes alone force you into a poor investment decision, but do not ignore taxes either. Depending on your country and account type, selling can create tax consequences, but holding a fundamentally damaged investment solely to avoid realizing a loss can also be costly. Consider the after-tax outcome, the quality of the investment, and your broader financial circumstances. Tax considerations should be part of rational decision-making rather than an emotional excuse to avoid acknowledging a mistake. Recognize recency bias, because recent events can feel more important than they actually are. If a stock has risen for 6 months, you may assume it will continue rising. If the market has crashed recently, you may believe another crash is inevitable. Review longer historical periods and examine the underlying business. Recent performance contains information, but it should not automatically dominate your entire expectation about the future. Avoid extrapolating extraordinary growth forever. A company that grows 50% for a few years may not be capable of maintaining that rate indefinitely because markets become larger, competition increases, and mathematical growth becomes harder at greater scale. When you see exceptional growth, ask how much of it can realistically continue. A good investment does not require you to assume that an extraordinary growth rate will continue forever. Conservative expectations can protect you from paying for unrealistic futures. Be careful when everyone agrees on an investment story because consensus can already be reflected in the price. A popular company may deserve attention, but popularity itself is not an investment thesis. Ask what expectations are already embedded in the valuation and what could cause those expectations to disappoint. If almost everyone believes the company will dominate the future, the market may already be charging you for that success. Attractive investments can sometimes exist where reality and expectations are significantly different. Do not automatically reject unpopular companies because public opinion can become excessively negative. A strong business facing temporary problems may sometimes trade at an attractive price when investors focus only on short-term difficulties. However, being unpopular is not enough. Investigate whether the problems are temporary or structural. The psychological advantage comes from being willing to examine situations independently when the crowd is either excessively optimistic or excessively pessimistic. Develop the courage to act when your analysis supports an investment, but only after understanding the risks. Contrarian thinking does not mean buying whatever everyone else dislikes. It means being willing to make an independent decision when your analysis differs from the crowd. If you have researched the business, understand the valuation, identified the risks, and believe the market's expectations are too pessimistic, excessive fear should not automatically stop you. Courage should come from preparation, not recklessness. Never confuse contrarianism with intelligence. Buying against the crowd simply because it feels sophisticated can be just as foolish as blindly following the crowd. Sometimes the majority is correct. Your job is not to disagree with everyone. Your job is to evaluate the evidence independently. If your analysis agrees with the crowd, invest if the opportunity is attractive. If your analysis disagrees, act differently for a specific reason rather than for the satisfaction of being different. Part 10. Protect yourself from narrative bias because a compelling story can make a weak investment appear attractive. A company may have an exciting future story involving artificial intelligence, global expansion, revolutionary products, or enormous market opportunities. But stories need economic evidence. Examine revenue, margins, cash flow, competition, capital requirements, and valuation. Ask whether the numbers support the story. The more exciting the narrative, the more important it becomes to check the underlying facts. Ask what could permanently destroy your investment before buying it. This psychological exercise forces you to confront uncomfortable possibilities. Consider technological disruption, debt, regulation, competition, management failure, customer concentration, fraud, declining demand, or structural industry change. You cannot predict every problem, but identifying the major risks helps you avoid investments where permanent loss is difficult to estimate. Understanding downside can make your confidence more rational. Learn to recognize when your original thesis is broken. A thesis is not broken merely because the stock falls. It is broken when important assumptions about the business no longer hold. Perhaps customers are leaving, margins are collapsing, debt has become dangerous, management has destroyed capital, or a competitor has permanently changed the industry. Define these potential failure conditions before investing. This makes it easier to act rationally when important evidence arrives. Avoid making a decision simply because you have already spent many hours researching an investment. Time spent studying a company is not a reason to buy it. You may discover after extensive research that the valuation is too high or the risk is unacceptable. That is not wasted time. You have learned something and protected your capital. Your research should help you make better decisions, not pressure you into making a purchase. Remember that saying no is an investment skill. Every dollar you invest in one opportunity cannot simultaneously be invested elsewhere. If a company does not meet your standards, rejecting it protects your capital and your attention. Strong investors do not need hundreds of investments to feel productive. They can wait patiently until they find opportunities they understand and consider sufficiently attractive. Build a temperament that allows rational decisions when other people are emotional. Investing rewards the ability to remain calm when prices move dramatically. When others become euphoric, maintain skepticism. When others become terrified, maintain analytical discipline. This does not mean automatically doing the opposite of everyone else. It means refusing to allow collective emotion to replace your own evaluation of business value and risk. Think about your investment decisions as repeated games over decades rather than one-time bets. You will encounter bull markets, crashes, recessions, bubbles, technological revolutions, disappointing companies, spectacular companies, and unexpected events. You do not need to win every decision. You need to remain financially capable of participating in the next opportunity. Protecting your capital and psychology allows you to keep playing the long game. Make your financial goals more important than your desire for excitement. If your goal is long-term wealth, every investment decision should be evaluated according to whether it moves you toward that goal. A speculative trade may be exciting, but could be completely inconsistent with your objective. A boring investment may feel uninteresting, but could fit your plan perfectly. Ask whether the decision improves your financial future rather than whether it makes you feel excited today. Remember that the biggest psychological advantage in investing is discipline. Knowledge matters, but knowledge without emotional control can still produce poor decisions. You can understand valuation and still panic sell. You can understand compounding and still chase quick profits. You can understand diversification and still become dangerously concentrated after one successful investment. Discipline means repeatedly applying your principles when emotions are pushing you in the opposite direction. Think like a long-term owner and let patience, rationality, humility, discipline, and compounding work together. Protect your capital, understand what you own, avoid unnecessary risks, control your emotions, question your assumptions, accept uncertainty, and give strong investments enough time to develop. The psychology of successful investing is not about becoming emotionless or predicting the market perfectly. It is about building a temperament that prevents temporary fear, greed, ego, excitement, and social pressure from controlling permanent financial decisions. Inspired by Warren Buffett's widely discussed long-term investing philosophy, the deepest lesson is that becoming a successful investor is not only about finding better investments. It is about becoming the kind of person who can hold, evaluate, and manage investments rationally for many years.